Okay, so let's jump right into a really fascinating puzzle. We're looking at a company that, by all accounts, is an absolute powerhouse, a market leader with incredible numbers. The thing is, it's also sending some really weird and confusing signals to investors. So, let's piece together the clues and try to solve the financial mystery of Hindustan Zinc. First up, the good news. And when I say good, I mean fantastic. The company just posted its third quarter results, and its net profit shot up by a massive 46% year over year. That's a record, by the way. Numbers like that should have investors celebrating, right? And this is where it gets strange. Record profits, but then the stock suddenly takes a nosedive, dropping almost 7% in a single day. There was no bad news, no operational problems, nothing. So what on earth happened? That's the big question we're going to tackle. All right, to really get to the bottom of this, we first have to understand just what a beast this company is. I mean, we're not talking about some small-time player here. This is a true giant. Let's build the case for why this company looks, on paper, pretty much untouchable. First off, just look at its market dominance. Hindustan Zinc controls a staggering 75% of India's primary zinc market. Just think about that for a second. 3/4 of the entire market. That is a level of control that most companies can only dream of. And you know what? It doesn't even stop with zinc. Because as a byproduct of all their mining, they've accidentally become a global powerhouse in precious metals, too. They are the third largest silver producer in the entire world. That's a huge deal. The full year numbers from fiscal year 25 just make the picture even rosier. Revenue is up 18%. Net profit is up an incredible 33%. But check out that EBITDA margin, 51%. For anyone who follows business, you know a margin like that means this company isn't just growing, it is incredibly profitable and efficient. I mean, you've even got the CEO, Arun Misra, basically saying, yeah, we're crushing it. He called their performance a reflection of operational excellence and strong fundamentals. And honestly, you can't really argue with him. This company is firing on all cylinders. So, who owns this giant? The promoter group, Vedanta, has the biggest slice of the pie. But look who's number two, the government of India. Now, this is a really important detail to remember. Having both a massive corporation and the government as major stakeholders, well, that becomes a key piece of our story. So, if everything is so great, what caused that 7% stock drop? Well, this brings us to the first major clue in our puzzle, a really surprising move made by the company's majority owner. Here's the deal. The promoter, Vedanta, suddenly sold off a 1.6% stake. Now, 1.6% might not sound like a lot, but it was a massive block deal that flooded the market with over 3,000 crore rupees worth of shares. And the crucial thing to understand is the price drop wasn't because the company was doing badly, it was a direct result of the promoter's actions. But why does that cause such a panic? Why would an insider, the person who knows the company better than anyone, selling shares make all the other investors so nervous? Well, it really boils down to a few key worries. First, investors start thinking, uh-oh, does the parent company need cash badly? Second, it's a huge signal about confidence. If the insiders are getting out, do they know something we don't? And finally, it just looks like they have less commitment, less skin in the game. That sale from the promoter definitely planted a seed of doubt. So now our investigation has to pivot from looking at actions to looking at the cold, hard numbers. Let's forget the market noise for a second and ask a fundamental question. What is this company actually worth? To figure that out, analysts use a tool called discounted cash flow, or DCF. Now, it sounds super technical, but the idea is actually pretty simple. It's just a way of calculating a company's true value today by looking at all the cash it's expected to make in the future. The process basically works like this. You project all the cash the company is going to generate. You figure out what all that future money is worth in today's terms. You make a few adjustments for things like debt, and then you divide the whole thing by the number of shares to get an estimated price. So, what does a DCF model say about Hindustan Zinc? The results are, well, pretty dramatic. According to one analysis from a platform called Alpha Spread, while the stock was trading at nearly 700 rupees, its real intrinsic value was estimated to be only about 407. Yeah, let that sink in. This model suggests the stock isn't just a little pricey, it's potentially overvalued by a whopping 42%. This adds a huge new layer of complexity to our mystery. The company looks incredible on paper, but this model is screaming that the price is just too high. Okay, so we've got a puzzling sale from the promoter and a very worrying valuation. Now we get to the final, and maybe the most serious, piece of the puzzle. It's a risk that actually has nothing to do with Hindustan Zinc's own operations, but everything to do with the company that owns it. The plot really thickens when you zoom out and look at the parent company, Vedanta. Not too long ago, a financial research group called Viceroy Research published a report with some pretty serious allegations against them, and that report casts a very long shadow. Now, it's really important to be clear that these are allegations from a single research report, but they are serious. The report claims Vedanta used another subsidiary to get a massive loan and then funneled that money back to the parent company. And here's the real kicker. The collateral they allegedly used for this loan was shares of Hindustan Zinc, which raises major questions about corporate governance. So, where does this leave us? It feels like we've uncovered two totally different stories that are somehow both true at the same time, pulling this one stock in opposite directions. This is the heart of the investor's dilemma. Let's just lay it all out. On one side, you have the powerhouse, a market-dominating giant with record-breaking profits that pays reliable dividends. But on the other side, you've got the problems. The promoter is selling off their stake, valuation models suggest it's way overpriced, and there are these very serious allegations hanging over its parent company. And that really captures the central conflict perfectly. At its core, Hindustan Zinc is a fundamental giant, just an operational masterpiece. But it's stuck operating under this big, dark cloud of external risks that are all about its owners, its valuation, and its governance. Which brings us to our final question. For a company like this, what matters more in the long run? Is it the incredible strength of its own business fundamentals, or is it the troubling governance questions hanging around its parent company? What tells the real story? That is the billion-dollar question for any investor trying to figure out this financial mystery.